Assalamualaikum and salam sejahtera from Dr. Ridwan. We now at the chapter 9, Variance Analysis. When it's outcome of these chapters, we should be able to calculate the basic variances, able to complete variance analysis report for materials, labels, and overhead variances. We should be able to explain the causes of variance and implications of the variance analysis. And you also should be able to compare between actual and standard profit methods. Okay, controlling is one of the important role within the management functions. So it involves monitoring and evaluating the performance of a business to ensure that goals and objectives are being met. So the key aspect of controlling actually uh, as a comparison to the standards and actual result. So manager need to compare the actual performance of the business against pre-established standards. So this comparison helps in evaluating how well the business is performing. So standard costing actually is a technique used to assess performance. So it involves comparing actual performance with standards, the expected performance to identify variances. So the variances are the differences between the actuals and the standard performance. So identifying and analyzing these variances actually help manager to rectify mistake. So address so they can address any issues that may have a cost variances, and also for improve performance, which is the implement corrective action to enhance future performance. So controlling actually help managers to ensure that the business is on track to meet its objective and allows for timely interventions to correct any deviations. Okay, standard costing is a key tool used in management accounting to control costs and improve efficiency. So it involves the use of standard cost and revenue as benchmark for evaluating actual performance. So the use of standard cost and revenue. So actually the standard costing involves setting standard cost and revenue for various activity within the organization. So this standard act as a benchmark or target that the organization aim to achieve. So in terms of control to the variance analysis, the primary purpose of standard costing is to control costs and operational efficiency through the variance analysis. So the variance analysis involve, comparing actual cost and revenue with the standard cost and revenue to identify variances. So variances are the difference between what expected and what actually occurred. In terms of the predetermined costs, actually the standard costs are predetermined costs that are expected to be attained under a given set of operational conditions. So which means that these costs are set based on history data, industry benchmark, and management expectation of future performance. And then the predetermined costs take into account the specific operations conditions under which the organization operates. So these conditions include factors such as production capacity, efficiency level, material cost, and leverage. So the standard costing actually help managers to monitor and control the financial performance of the organizations by analyzing variances. So manager can identify areas where performance divide from the expectation and take correction actions to improve efficiency and cost effectiveness. We see the steps in the standard costing. The first step is actually you need to setting standard cost for different elements of cost, which is materials, labor, and overhead. The second step is recording the actual costs. The third one is to compare between standard cost and actual cost to determine the variances. The fourth step actually is to analyze the significant variances to know the causes and implication. And last but not least, the fifth step actually to reporting the analysis of variances or to management for taking appropriate actions where necessary. Variance analysis. The variance analysis is a critical process in management accounting that involves evaluating the difference between plan and actual performance. So this helps in identifying areas where performance deviate from expectations and allows for corrective actions. So the key concept of this variant analysis is, the variant analysis involves examining the total difference between what was planned, that is a standard, and what actually occurred. So this analysis helps in understanding the extent and causes of deviations from the plan. And then in terms of the management awareness, if the variations arise, management becomes aware that the actual cost of revenue have different from the standard plan or expected amount. So this awareness is crucial for taking timely corrective actions to address any issue. So in terms of the calculating variance, the variances can be calculated for both costs and revenues. So the calculations help in quantifying the extent of deviation from the standards. So the types of variances, okay, in terms of the difference, the favorable variance actually is occur when actual costs are less than standard costs. Alternatively, when actual revenue is higher than the standard revenue. This indicate better performance than expectations. The second thing is the unfavorable variances, or actually is occur when actual costs exceed standard costs. Alternatively, when actual revenue is less than a standard revenue. So this indicate worse as performance than expected. So by understanding and analyzing variances, so management can identify specific areas where performance needs improvement and implement strategies to enhance efficiency and effectiveness. And so this process is essential for maintaining control over business operation and ensures that the organizations meet its financial goals. Okay, so what you can see, this is a step since variance analysis. The first step, actually, you need to compute, which means you have to compute the variance. And then the second one is to determine. So you need to determine the causes and implications of the variance. And then you have to identify. So you need to identify the performance achieved, and last but not least, is a take. So to take actions to correct the problems. Okay, from this table, you can see the variances can be break down into either price or rate or quantity variances. Uh, As you can see, the cost element direct material price variance actually is based on price, and then the quantity variant is usage. In terms of direct levels, the price variant is by identify the rate, and the quantity variant is the efficiency, the rate efficiency, and then the variable overhead actually is the expenditures, the cost of your expense, and is based on the efficiency in terms of the quantities variance. And last but not least, it's fixed overhead. Actually, the price variance actually is for the expenditures, and the quantity variance based on volumes. So this is the basic cost variances. If you see these diagrams, so it shows that the total basic cost variance, we have material cost variance, labor cost variance, variable overhead cost variance, and fixed cost variance. So in order for you to calculate the material cost variance, you can look into the material price variance and material usage variance. In terms of labor cost variance, you can calculate the labor rates variance as well as the labor efficiency variance. In terms of the variable overhead cost variance, you can seize the variance overhead expenditure variance, also the variance overhead efficiency variance. So fixed overhead cost variance, you can calculate the fixed overhead expenditure variance, and also you can identify what is how much the fixed overhead volumes variance. In terms of direct material cost variance, you can calculate the direct material price variance and material usage or quantity variance. Okay, the direct material cost variance, so the differences between the standard material cost of the output produced and the actual material cost incurred. So the equation for material cost variance or MCV equal to standard cost for actual output minus with the actual cost. So the formula to get the standard cost for actual output is standard quantity times by standard price. And in order to get the actual cost, you need to uh, find out the actual quantity times by actual price, then you get the actual cost. In terms of direct material cost variance, actually they comprise of direct material price variance and direct material usage variance. So the formula of material cost variance equal to material price variance plus material usage variance. Then you can get this material cost variance. Now you can see, to be specific, the direct material price variance or MPV actually is the difference between the standard price and actual purchase price for the actual quantity of material. So the equation for material price variance MPV equals to AP, yeah, or actual price per unit times by the actual quantity of material purchased. And then you minus with the standard price per unit times by the actual quantity of material purchased, or or the equation to simplify the equations, it could be the actual price per unit minus with the standard price per unit time with these the totals of of this transaction can be time with the actual quantity of material purchase. This is the material usage or quantity variance, which is the difference between the quantities of materials actuals used and the standard quantity allowed. The formula is for material usage, variance is standard price per unit times by the standard quantity material used minus with the standard price per unit times by the standard quantity for the actual output. Or you can simplify the equations to actual quantities material used minus with this standard quantity for the actual output. Then you can time with the standard price per unit. So actually, and then you can get the variances if unfavorable when the actual quantity of direct material used is more than the standard of quantities allowed. Okay, now let me see this direct labor cost variance, which is we can also find out the labor rate variance and also the labor efficiency variance. Okay, so the direct labor cost variance or LCV actually is the difference between the standard direct labor cost and the actual direct labor cost incurred. So the formula for labor cost variance (LC or LCV) equals to standard cost for actual output, which is standard hours times by standard rate. Um, so minus with the actual cost, which is the actual hours times by this actual rate. So direct labor cost variance actually comprised of the labor rate variance (LRV) and also the labor efficiency variance (LEV). Yeah? So the formula, the equation for the LCV equal to LRV plus LEV, yeah, which is the direct labor cost variance equals to labor rate variance plus labor efficiency variance. Now let me see the labor rates variance. So the labor rates variance (LRV) actually is the difference between what was paid to direct labor and what should have been paid. So the equation for this labor rates variance actually is equal to actual hour wages wages rate time by the actual direct labor hour use. So minus with this standard hourly wage rate time by the actual direct labors hour use. And if we simplify this equation, so equals to the actual hours wage rate minus with the standard hourly rate and time by the actual direct labors hour use. So the differences of this is if is unfavorable if the actual rate is more than the standard rate. So if less than become favorable. And you can see this level efficiency variance or LEV actually is the difference between the levels hours that were actually used and the level hours that should have been used. So this level efficiency variance equal to actual direct level hour use times by the standard hourly wage rate and minus with the standard direct labor hour for actual output times by the standard hourly wage rate. And this, we can simplify the equations to our actual direct labels hour use minus with the standard a direct labor hour for actual outputs and time with the standard hourly wages rate. So the variances is unfavorable when the total actual hour use more than the total standard hour. Okay, now we try to understand what is the idle times variance. Okay, idle times variance. So the idle times variance is an important concept in management accounting, particularly in the context of the labor cost control. Actually, it represents the times during which employees are paid but are not engaged in the productive activity. So the key points about the idle times variance actually when we look into the definitions. So the idle time refer to periods when labor is not actively involved in production's activity. So it occurs when employees are compensated for times during which they are not working. So the cause of the idle time actually is if we look into the unforeseen circumstances, actually unexpected events that cause halt in production, such as power failures or machine breakdowns or shortage of material. So in terms of the bottlenecks in productions, actually that is where the situations where the production process is delayed or altered due to the various issues such as equipment failures, or lacks of necessary resources. And then in terms of waiting for instructions, which means the period when employee are waiting for further instruction or information to continue their works. In terms of the trade recession, it means that economic downturns can lead to reduced production demand and consequently less work for employees. And last but not least, the unfavorable variance due to the inefficiency utilizations of labels, which means it could be because of the poor planning or mismanagement leading to inefficient use of labor resources. And then the level efficiency variable will only be calculated using this active hour works. So this is the, in terms of the unfavorable variance. Uh, so actually the idle time is always described as an unfavorable variance because it indicates loss of productivity and efficiency. So it represents a cost without corresponding output, which negatively impact overall performance. And then the impact on labor efficiency variance. So actually the labor efficiency variance, which measure the difference between the actual hour works and the standard hour expected for the production achieved, only consider active hour works. So the idle time is excluded from this calculation as it does not contribute to the productions. If you have any questions, you can ask during our face-to-face class or you can write them in the chapter forum in class. Bye for now and see you in part 2 of these chapters.